All right, welcome to today's live analysis where we will be going through the market condition and the outlook for April 2020. Right, so before that, let me before that, let me okay, so this is the chart for the SPY, the ETF that tracks the S&P 500 uh, index, which tracks the top 500 companies of the US market. So currently you can see that in the past month, in starting ever since the mid of February, we have experienced a very huge plunge from the top from the top of about $338 all the way down to $220. And the only small rally that we have during this huge plunge of a month is this small rally over here. So this is the only small rally that we have experienced back up to the around the 100-day moving average, which is the yellow orange line shown here. And other than that, it has been a straight downward plunge all the way since. And let's just take a look at how much has the market dropped so far. So from the top, from the peak to the bottom, it has already dropped 35, 36 over percent. And you can see this over on the info box over here. When I mouse from the bottom to the top, you can see that it has occurred over the past 24 days and we have experienced a huge 35% drop. So all this while I've been waiting for a relief rally and thinking that a relief rally is overdue. And true enough, we have the bottom so far experienced, sorry, so far we have found the bottom at around on the 23rd of March at a low of about 218. And subsequently, we have experienced a huge relief rally all the way back up to the 261 level. So, and what's surprising is that despite a negative news whereby the US has announced the unemployment rate on this day to be at 3 million over unemployment, which is the largest number so far in history. Okay, it has even exceeded the amount that the number of unemployment has even exceeded those observed back in the 1920 Great Depression. That's one of the world's greatest crash that the market has experienced, whereby the market has plunged 80 over percent. And this time around, 3 million unemployed numbers. And despite the market reacting negatively to this news, you can see that the market shot up very strongly from starting when it opens at 250 all the way back up to 260. So what does this tells us? Whether or not will there be, as in where what do we expect from here moving on? Now the best we can do to sort of not say predict but to analyze and have a feel of where the market will be going is to one way is to go through the by is by looking at the historical lessons that we have experienced so far. And this is daily chart. If we look at the weekly chart and we see, if we go on to the weekly chart and let me put on all the indicators. All right, so you see if we go back to the 2000.com crash, what has it told us? Okay, never mind. Let's go back out and look at the bigger picture. You see on the weekly chart, it's very seldom when we experience the oversold level in the S&P 500. So the oversold level is you can tell that the S&P is oversold when you look at the RSI and it has crossed below the green. Okay, and it has crossed below this lower boundary over here. So this instant when S&P 500 when the SPY gets into the oversold boundary, it has also experienced a very huge plunge downwards, and then when it gets oversold, it gets a huge relief rally back up to where? To the immediate to the immediate 20-day prices. Likewise, experience a huge drop and then go back up to this time the 20-day exponential moving average. And then another example over here, you can see on the 2007, 2008 global financial crisis. Once again, we see the oversold territory being visited by the prices again, and likewise, after a huge plunge downwards, a relief rally back up to the 20-day exponential moving average somewhere near was seen before another plunge downwards and then followed by a greater recovery. So this time, what do we have? You see that throughout history, there's only one time, two time, and three time whereby the SPY has reached the oversold level by using this RSI. And this is the fourth time that this phenomenon has surfaced again. So likewise, when you see this, what do you expect? You expect that prices should bounce back up, should should experience a brief recovery and bounce back up to the nearest level of resistance. So in this case, what we can see here, we can see that there's an immediate resistance at 255 level, and another sign where we can see that the SPY is deeply oversold is through the divergence in the MACD. So can you see if we switch out to the daily chart again? Now, can you compare the low that was made in 2016 to compare it to the low that was made in the March 23rd this year? If we connect these lows, okay, from the 2016 the 2016 low to the current low that we have right now, and if we likewise we connect the same low on the MACD chart, on the MACD line, what do you see here? The prices is making a higher low, but the MACD is making a lower low. So what does this tells us? It tells us that the MACD has gone, that the prices have dropped down too much, so much so that the MACD, sorry, let me rephrase that. It has told us that the plunge is too fast, too steep, and that's which is reflected by this huge MACD drop that is experienced over here. And we haven't even reached the previous low that was encountered in the low of March 2016, and yet the MACD has already breached the low of 2016. So this tells us that there's a divergence occurring and give us another evidence that the the selling off is too much and too drastic already, and there should be a relief rally coming up soon. And true enough, we have a relief rally that has so far been occurring for the past 4 days. And on Friday, we closed sort of flat at 200, and we opened at 253, went back up to the high of 260 over dollars, come to the low of 250, and then close back at 253 again. So I'll say that this is a consolidation. The market participants were unsure of where to go and waiting for the weekend, see if there's any news coming out before making their decision. So can we say that the bear market is over? It's hard to say. It could be over for all we know, and the prices could continue to rally up all the way to the high before maybe another drastic event that happened again, and then we fall back down to visit the low again. So this is one possibility. All right. So now, how can we prepare ourselves for this rally and see where are the likely levels that the rally is going to turn reverse and show signs of reversal back down again. We could prepare ourselves and inform ourselves of the likely resistance level by using the Fibonacci retracement tool. So for those of you who have watched my past analysis, you know that I use this tool a lot, and this is my favorite tool to use to judge and gauge where are the likely resistance level. So how do we use this level is we want to connect the high to the low of a wave. And in this case, it is making a downward move. So this is what we call, in a downtrend, the downward move, we call it the impulsive wave. And then the upwards move, the rally, the brief rally that we have experienced here, we call it the corrective move. So we want to connect from the top to the bottom, and this is what we get. We get the different Fibonacci resistance level that most traders would that most market participants will look out for. So let me clear the chart and make it cleaner so that it will be easier for you to see. And here we have it. So if I drag this out over here, and all right, so what do we see here? Can you see a lot of coincidence and coincidence that's occurring on the chart? So the 38.2, I'm not sure if you can see clearly, is overlapping. The 38.2 Fibonacci retracement level is right here. The 50%, is not really a Fibonacci number, but it is still a level that most traders and investors look out for. The next Fibonacci level is the 61.8, and then lastly the 100% level. So what does this tell us? It tells us that the 38.2 coincides with the 255 level, which has been previously observed to be a strong resistance. So if I zoom out 255, you can see that it has been respected as a support once, support once, support once. Here not so much. And then right now what it should tell us that is that the 255 level should be of somewhat importance. And if we look at the past few days of the downtrend, we can see that the 255 level is indeed resisted quite a few times. Once here, this big long green bullish pin bar. So what this pin bar tells us is that the prices went down and then support by the 255 level, and then it go back up again. And then, but it only held for one day, and the next day prices gap down, and then on that day itself, prices attempt to go up, but resisted by this 255 level again. And on this candle, likewise, go up, hit the 255, come back down a little bit, and then this level could not hold much longer. Prices continue gapping down. So on its way up, what would you expect? This level 255 would be a significant resistance. And furthermore, it is also marked by the 38.2 Fibonacci retracement level. And likewise, during this day of a rally, we see that it was resisted once, and on Friday, it resisted the upwards move the second time. Now, the 38.2 level, the fact that this rally has reached the 38.2 level, it shows that there is a slight strength in the rally. So if the rally have more strength than that, we can expect prices to continue upwards and hit the 50% level. And look at this. The 50% level coincides with the 20-day exponential moving average shown in the red dotted line here. So if this rally is strong, it has enough power, it will be able the next upward move heading as we head into next week and also into April will be to experience maybe a slight up and down and up to hit this level. If the buying pressure is so strong, it could hit it within a few days. And after it hit this level, what next? The next level to look out for will be the 61.8 Fibonacci retracement level. And this again coincides with the 280 horizontal resistance, which has also been shown to be a rather strong support and resistance. So support, resisted, broke through, and then come back, resisted. When it broke through, it supported, resisted so many times over here, and then support for a while. So you can see that 280 is also a strong level, and it coincides with the 61.8 Fibonacci retracement level. And by the time prices would have moved up to this level, you could expect that the 40-day 40-day exponential moving average, the 40 EMA, would have also coincide at this area over here as well. So you can see that indeed 280 will be a very, very strong resistance level to look out for. If prices can reach this level, it shows that the buying pressure, the rally this time around is really very strong. But that does not mean that we will never come back down again. For all we know, when we go into March, some oil tension spark out again, and then we may come back down again. So keep your minds open. Whenever we see a bearish candlestick pattern, for example, let's say one black crow happening over here, and this bearish candle will close below the low of the previous day's bullish candle, we can take this as a opportunity, as a signal of a bearish reversal and that prices are about to head down. So if you see this type of scenario happening and you want to protect your portfolio, you can start taking on some short puts, and perhaps maybe you could short the ETF or long the inverse SPY ETF, which is the SH, or you can buy some protective puts for your portfolio. And where would be the next target down? It could very well be the low that we have experienced over here. You could say that the 23.6 level Fibonacci retracement could act as somewhat of a support, but I doubt so. It looks to be quite weak, and it is generally quite a weak level to begin with. And likewise, if the prices have enough strength to shoot up to the 280 level, you can wait for a bearish reversal candle. So maybe we have a green candle over here, and then one black crow over here, and this would be your signal to short for downright for the next right downwards. Now, of course, nothing is 100% probable. It could show you a bearish candlestick pattern, and then prices go back down a little, and then continue go up. And at this level, a bearish candlestick pattern again, goes down a little bit again, hit the 255 as a support, and then continue shoot back up. So always act accordingly and react fast enough to the technical charts that that you will be looking at. So these technical indicators and the chart will serve as a very important guide to help you navigate through the markets. Another scenario that we can say that could likely happen is that this is really just a brief rally and not a recovery from the bear market. And then from here on, maybe prices will drop back down even lower. But what are the chances of that? I think given the current situation that we are facing, which is the coronavirus and all the lockdowns and all the widespread of the virus and lockdown and the stoppages of jobs and everything. But however, I think that it is not going to be that severe because the economy, like the US have been saying, has been strong previously. So what is happening right now is that people are not able to spend their money. They have the financial capability but nowhere to spend because everywhere is being shut down. So all we need is for this virus to get better. And in fact, the US and the other nations are already making great efforts in making sure to restrict further spread of the virus already. So as long as the virus can stop spreading, the number of cases, infected cases, new cases each day can plateau off. I think this should be a good enough reason for the market to rally up strongly. And this is not without any base. I'm not making this without any basis, because if we go back to even the previous bear markets that we have. Let me switch this to the monthly chart for a more compressed view. Now, how much drop do we experience in the previous bear markets? in the 2000.com bubble, I think the lowest that the market has dropped is about 49%, and the global financial crisis about 56%. And from just now, you see when I measured out the plunge that we have experienced so far for you, we have already experienced a 36% drop in a matter of just 4 months. So I think this is really a very big drop already, and that most of the negative news have been priced in. And you see that previously, even when faced with 3 million unemployment numbers, the market did not react negatively. So this is a good sign that, perhaps the worst has been priced in already. Yeah. So it's not loading. All right, never mind. Let me bring up another. So do look out for my new video on the bear market analysis, whereby I will be going through the previous lessons that we have faced and how to better deal with the bear market situation like this. So back here we see in the previous bear markets, the 73-74 crash, it was almost a 50% plunge. The 2000.com crash was also 50%. 2007 global financial crisis, that was one of the worst, the 56% crash. So right now we are at negative 36. And if you compare this number with the average of all recessions is negative 31%. I mean, average of all bear markets. Sorry, pardon that. And the average of all bear markets with recessions is 37%. So do we have are we going to face a recession this time? It's hard to say. I'm not I mean I can't comment much on that, but we are already very close to this number over here. And if we continue further down, continue to drop further down, maybe at most we could have another 24% drop, whereby we reach a negative 60% plunge from the peak to the bottom. Right? So worst case, maybe another 24% more to go. Best case is that this is really the bottom, and there could be more upside to go. So as an investor, like I've always been mentioning throughout all my videos, is to stick to your what's that your dollar cost average schedule, and then just to add frequently. There's no way that you can really time and catch the bottom time and again consistently. So even if you did it once or twice, I can say that most likely it is largely due to luck, and it is very hard for you to repeat this again and again. All right, so it looks like the chart is dying on us. Okay. All right, never mind. So for those of you who are interested in how I've been performing, so this is my trading portfolio. You can see that it's not doing very well, not spectacularly well. If you have watched my previous analysis and on how on whereby I explained how I beat the market on this huge downtrend and then protected my portfolio. That was the biggest increase that I have. We hit at we hit about 24% year-to-date return back then. And afterwards, my portfolio has been rather much breaking even, going flat since. But I have to say that it's good enough. At least it didn't decline together with the market. Although you can argue that it is slightly making a sort of like a higher high, higher, a lower high, high, lower lows here. So moving on, I hope I'll be able to catch the correct opportunities to protect my portfolio and even go further up from here on. So right now sitting at a cumulative return year to date of about 19%, and versus the SPY, I think that is good enough. And as for my investment portfolio, long-term investment portfolio, this is how it has been doing. Negative 13.22, negative 13%. It is overall still uh, a lower drop, sort of to say, than the general decline in the S&P 500. So this is the importance of using like value investing analysis. So whereby you can accumulate your stock at undervalue or fair value, and when the market experience a huge crash like this, your portfolio will not experience so much uh, of a of a negativity, because you have the margin of safety over there. And you can see that most of my purchase, my average my average cost price is rather low. For example, Facebook is sitting at 174, and if you recall, at the peak, the Facebook was at like 200 and $220. So I have quite a huge profit over there, and then it when it collapsed back down, I did not lose as much. So similarly on Alibaba 170, even you can see even right now is still at a profit. Tencent the same, and Amazon is also roughly break even. So most of my losses are from the emerging market ETF and also the China ETFs. So for this, I must say that my timing of the entry has been quite bad, because I was experimenting with like cash secured put to like increase the returns for my portfolio. And right now you can see that I'm slightly hedging from the brief rally that we had. I recently I've sold a call for the FXI China ETF at a 38.5 strike. So what this means is that if FXI goes down from $38.5 from here on, I'll be making a I'll be earning the premium of $1.35 from here on. And this will help to hedge against the loss that I've made on the FXI position, which is over $1,000. So negative 16%, and all these puts and calls will hedge for the loss, the temporary loss that's been incurred over here. So if you are new to the channel, so make sure to look to go through our content-rich videos, where I've explained like how to do your own value investing to analyze for strong companies and the intrinsic value of these strong companies, as well as technical analysis. If you have seen how I've analyzed the chart for you previously, and uh, just previously. And if you like to know how to do this all by yourself, you can look at the technical analysis video that I've done up previously. So how to draw your own effective trend lines, like those that we have seen on my chart, how to identify candlestick patterns. So the candlestick the bearish reversal candlestick pattern that I've mentioned previously can all be found here. And these chart patterns is more for trading. All right, so with that, I want to move on to the value plays that we have as we move into the month of April. So after facing the huge drop over there, you can bet that a lot of the fundamentally strong stocks are at fair value or undervalue right now. So previously I've done up okay, let me come. I've been looking at some companies. So one of them is Intel. You can see that Intel is a very strong company. So based on my 7-step strategy, you can see that the first step, increasing business profitability, it has been increasing for the past 5 years very nicely, barring the net income, some problems, some flat problems over here. And then, but if we overlook that, it's all right. And then cash from operating activities is also fine. The earning per share is slightly low, not the desired double digit that we want, but it's all right. It has a very strong competitive advantage, ROE, satisfy, and at this period right now, whereby the market is being faced with all the margin calls and all the debt issues, step 5 is the most important step to look out for right now, or along with step 1. So step 1 tells you the health of the business. Step 5 tells you the risk of the business. So right now you can see we want companies with as little debt as possible, so that moving on, if there is any recession or financial crisis were to happen, at least these companies with a conservative debt, a reasonable debt, they are able to make it through. They will be in a better position than their peers. And for Intel, what we see here is that their current ratio is healthy. It has a higher total equity than liability. So this, in a sense, tells us that it has the ability to pay. It is solvent. At least the company is solvent. And when faced with a forced liquidation, there's still at least equity left over. And then lastly, we can see that the amount of cash flow that they are paying, that they are using up to pay for their interest is 0%. Instead of paying interest on their debt, they are receiving interest on some investment activities that they have made up, perhaps. So if we calculate the intrinsic value of Intel, we can see that currently, right now, the intrinsic value is at $84. All right, $84. And if I show you the Excel sheet, so this is an intrinsic value calculator where I use to keep track of all the strong companies that I've analyzed before. So Intel is over here. You can see the current price is at $52.37. So pardon the rate highlighting, it was a mistake. So what does this mean for us? It means that it is currently sitting at a 37.8% discount. So for those of you who are interested in semiconductors or chip companies, Intel will be a good choice. It will be a good choice for you. So what are its competitors? So competitors will include like AMD and Nvidia. So AMD right now, if you have been following the news on this industry, you can see you will know that AMD has been a hot rising stock ever since 2019. It has rose up the most, over like 100%. But the fundamentals of a company is still a bit wobbly. It's not so stable right now. So I will stay clear of that for long-term value investment. And for Nvidia, it is currently the fundamental is not that as bad, but the IV is slightly overvalued. Another competitor of Intel would be Taiwan Semiconductor Manufacturing Company. So this is another one. This is one of the analysis that I've done previously in one of my value analysis video series. So I've updated the no, these are the numbers from back then, and we can see that TSMC is currently valued at 1,638 Taiwan dollars, and converted to USD, it is about $54.54. And likewise, if you look at the fundamentals, very strong business growth, and then debt-wise, it is also very safe. So these are the companies that we want to focus on right now. And then TSM. All right, the chart is back. All right, now it's lagging again. Okay, never mind. So we will get back to the chart later. Other than that, all the strong technology, the strong tech giants like Facebook right now is also very undervalued. The IV is at 208, which I've just analyzed it today, just a while back for you. So we can see that it is sitting at a 24% discount. For Apple, it is slightly, we can say that it is at fair value. IV with 218, current price right now is at 247, 250. If we consider fair value to be IV plus 25%, it is currently within our within our 25% mark. So you can say that it's fair value. If you want, you can nibble a little bit right now. So for other companies like Google is also uh, at fair value, and other companies like yeah. So that's pretty much it. And there are other companies like Alibaba, Tencent, Ping An Insurance, Microsoft. So all these I'll leave the analysis up to you. All right. So do you guys have any questions for me? Okay, I'll be open to questions. So you are feel free to to voice out your views. I'm sure that what I've said just now are just purely my views on the market situation. Of course, okay, is there a video on how to calculate the IV? Yes. So it's all over here. You can look at our value investing course. So how to do the all the steps of the value investing analysis over here, and the breakdown where I explain in further details. So this video right here uh, will show you how to calculate the IV, and this will show you how to make your own calculator, Excel sheet calculator. Yes. So hope that helps you. And yeah. Okay. And then if you would like a more timely updates from us, you can also look at our Facebook and make sure to follow us as well. Over here, I post rather frequently, a few times a week on current on immediate on the immediate market situation. So like what I've said previously on the huge rally that we've experienced, I've posted here as well before, so you can roughly read about it. So it is what I've discussed previously, and it was posted on the March of 25th March. So, and previously on the short term chart analysis, so they are all posted on our Facebook page as well. Okay, so personally, I feel that for coming April, it is going to be a rather volatile period. So you can see that the VIX is right now still at 60 over. So meaning to say that the market has not really settled yet, the dust has not really settled. So moving on, I personally for myself, I would like to see that the bear market is over and everything resume back into a uptrend from here on. It will be much easier to trade and also to invest in. But that's not to say that the volatility is not welcome. So as a trader and investor, if you're experienced enough, you should welcome volatilities, because these are the times whereby you make use of the irrationality of the market and the market participants to secure in good deals and also to ride short and quick way down for your trading. So secure good deals for your investment portfolio and then ride the trend up and down quickly for short-term profits on your trading portfolio. All right. So pardon my internet connection this time round. I would like to show you the trading positions that I have on my trading portfolio, but it is not really loading as well. I have much more positions than this. So currently, right now, I'm doing a Microsoft, what's that? Diagonal call. Yeah, a diagonal spread. I'm holding a Microsoft spread, a Merck horizontal spread. These are all my trading are mainly mainly focused on options. I rarely do swing trades anymore. But if you are interested in swing trading, also do look out for upcoming contents on my video. I'll be covering trading strategies soon enough, as well as how to understand options and how to trade options properly. Right. So Microsoft Merck, I'm also holding another position on what else do I have here? I have another position on EEM, also a horizontal spread. And then another one is Bank of America, a horizontal spread. Horizontal spread of with a price of $23. For EEM is $35. Merck was 85 horizontal spread. And then Microsoft, you can see it is captured here. So I'm selling 150 call that expiring April, and I'm long 145 call that expires September. So these are the current positions that I have on the market. On my trading portfolio. Look, as we head into April, I'm looking to pick up trading positions for Intel. I'm still deciding on whether for it to be a diagonal spread or horizontal spread. So a diagonal spread if you take on a diagonal spread, you are more bullish on the stock. If you are taking up a diagonal, you are more bullish. If you are taking up a horizontal spread, you are more neutral on the short-term price movement of the stock. So I'm still deciding on which one to take up. Currently, with the huge drop and Intel at about $54, I'm thinking it is quite worthwhile to start a diagonal spread, maybe with a long leg that is expiring at the end of the year, maybe December or January 2021, 2020 or 2021, and then just continue selling short-term calls along the way. So that's one idea that I have in mind, and another one I'm also looking to for this is for trading. For investment, I'm thinking of taking up a position in Microsoft. So you can see that my chart is not working, but you can see that previously back at the peak, Microsoft was about 200 over dollars if I'm not wrong, and right now it is at 145. At this current price of 145, it is if my memory don't fail me, it is currently at fair value to slightly above fair value, but it's good enough to nibble a little bit. And if it really drops more, let's say in the case of a 50-60% drop, then I'll go more. I'll go in with a heavier position. So this is also another value play that I'm looking at. So when you are talking about long-term investing, it is best to invest using cash and not to use margin. So the huge 36% plunge that we see, a lot of them are irrational selling because a lot of traders and hedge funds and institutions, they are faced with margin call as the market suddenly react negatively and is faced with a huge plunge, and then there's all the credit tightening from the government regulations, from the banks and whatnot. So they are all forced to liquidate to meet all their margin calls and what's more, they have a tighter margin call right now. So there's a lot of panic selling and just irrational selling. So in order to have a strong hand and not be forced to sell, it is best to hold your long-term investing positions with cash only. So with that, you know that no matter how low the market go, you you must be determined and not sell it off, because you know that in the long run, when we talk about long-term investing, we are talking about a time span of like 5 to 10 years. And in these 5 to 10 years, we are almost certain that stock price of fundamentally strong companies will at least double to triple in this time span. And why are you so confident? Because of the good fundamentals from the analysis that you have made. You see that it has been increasing consistently with a high growth rate. So in the next bull run, definitely these strong companies will double to triple or even more than that. So Microsoft could go up to 300 over dollar. Your Amazon could be like $5,000, and so on and so forth. And so right now, even if you buy, some of you, I've seen a lot of commotion in the chat groups and all the Facebook groups that I've been in, and saying, oh, what if you buy now and then it plunge further, plunge 50, 60%, or even worse, 80%. Well, the thing is, you never know where is the low. So currently it is at a 30% drop. Currently a 36% drop. Like I've said previously, what's the worst case scenario to come? Maybe another 24%. But what are you risking 24% drop for? For a huge upwards return of maybe 200 to 300 over percent. So is this good? Is this risk to reward good for you? This is like a 1 risk to 10 reward ratio. So definitely it is a good deal, and you do not want to miss out on that. All right. So can you post your new future trades on Facebook? Okay, yeah, sure. I'll be posting my trade ideas and what I'm about to enter on my Facebook, so that you guys will have insight to read. And then yeah, like I've said, currently my YouTube video pipeline is rather tight. So I'll be doing my best to push out video as fast as possible, and there will come and I will be making a video on diagonal spread and horizontal spread, and on how to trade options effectively is definitely what I want to do as soon as possible for you guys. I want to help you guys understand how to make use of these tools, and these tools are very important for you in times like this, whereby you need to hedge your positions and protect your portfolio. So a knowledge of these tools will be very important for you, and I would like for you guys to learn it as well. Right, so do I use IV to judge if options are expensive? So I don't really, there are ways to do it. There are ways to judge whether options are expensive. Yeah, that one you have to go into the delta, gamma, and the theta, and all those, and the vega. So these are the option Greeks that you have to understand more in depth in order to have a knowledge on what to do during certain times. So all these will be up on future videos, and I appreciate if you can help me like my video and subscribe to my channel, so as to push the content out for a wider audience, and more can benefit from growing wealth as a channel. All right, so with that, I'll end today's discussion, and I hope all of you guys have benefited from it. And remember to stay calm and not act like what most other retail investor would do. All right, stay calm, stay rational during this period. When you see drastic selling, take it as an opportunity to add low for your long-term portfolio instead, and take it as an opportunity to quickly write the trend down for your trading portfolio, or write the brief relief trend up for your trading portfolio. All right, so thank you so much for the follow on Facebook, and with that, I will look forward to our next interactive session together with you guys. All right, stay safe during this period. I hope none of us will be down with the virus, and stay safe, stay healthy, and thank you so much for watching. I'll see you next time. Thank you.